But if you held a silver contract or a physical coin, you weren't celebrating. You were watching your portfolio bleed out. While the crowd rejoiced at the strong economy, an execution was taking place behind the curtains. We call this the good news trap. The precious metals market, which just 48 hours ago was storming all-time highs at 95 to 89 per ounce, suddenly collapsed below 92 yawasek. Why? They will tell you it's geopolitics. Trump changed his mind about buying Greenland. That is a lie for tourists. The real reason is a single number published by the US Department of Labor, which triggered a chain reaction in the very heart of the financial system. Today, we will dissect the anatomy of this strike. Welcome to reality, the number that killed the rally. Most Wall Street analysts, those weather forecasters in expensive suits, expected a figure of Tatu 15,000 claims. They were betting that the economy was starting to cool, that people were losing jobs, that the Fed would see weakness and finally start cutting rates to save the drowning. But reality punched them in the face. The actual figure is 198,000. This isn't just lower than forecast. This is a break of the psychologically crucial 200,000 level. It is a signal that the labor market isn't just alive, it is overheated, it is white hot. For the layman, this sounds great. Everyone has a job. But for the macro investor, this is an alarm signal. Why? Because in a fiat money system, the strength of the worker is death for assets. The mechanics are simple and brutal. 1. Low unemployment means a labor shortage. 2. A labor shortage forces companies to raise wages. 3. Wage growth drives consumer demand. People spend, prices rise. 4. This creates inflationary pressure that the Fed is obligated to strangle. Jerome Powell and his team at the Fed look at the number 198K and realize we cannot cut rates. The economy is too strong. If we give them cheap money now, inflation will explode again. The policy of our higher for longer is no longer a threat, it is an inevitability. And the second the algorithms read 198K, they hit the yakto sell button on everything that doesn't generate dollar income. Silver is a zero yield asset. It pays no coupons, it pays no dividends. And when dollar rates remain high, holding silver becomes mathematically unprofitable for the robots managing trillions. The anatomy of the double strike. At the beginning of the week, the market was hysterical over the Greenland gambit. Trump's threat to impose tariffs against NATO and the EU drove investors into defensive assets. Silver soared, breaking $94 and hitting an ATH. This was the fear premium. But then Davos happened. Trump took the WEF stage and did a 180-degree turn, a framework agreement with Mark Rutte, a waiver on tariffs, a public promise not to use military force. As soon as the political risk vanished, the speculative foam began to settle. The war premium evaporated instantly. HFT algorithms, tuned to news headlines, switched from risk off, buy a bunker, to risk on, buy stocks. Investors began booking profits at the peaks. This created an avalanche of selling. But the geopolitical de-escalation alone would have merely returned us to the starting point. The real gut punch was delivered by macroeconomics. Geopolitics removed the fear premium, but the unemployment report destroyed the hope for cheap money. It was a double blow, a right hook from Trump and an uppercut from the US Department of Labor. Immediately after the claims data, 198K, was released, yields jumped to 4.6% white. You must understand what this means. US bonds are considered a risk-free asset. When a risk-free asset pays you 4.26% per annum. In the world's most reliable currency, the desire to hold a volatile piece of metal that costs $92 and could fall to $80 drops sharply among institutionals. Rising real yields, nominal rate minus inflation, are kryptonite for silver. Smart money saw the numbers and began capital rotation. They sold metal ETFs and parked cash in bonds or stocks, which, by the way, also cheered up. The S&P 500 and NASDAQ went up, drawing liquidity out of your pocket. The world's largest silver fund, iShares Silver Trust, SLV, recorded an outflow of nearly $700 million, $686.41 million. These aren't retail traders with coins. These are whales exiting the game while the water is still warm. They are using the liquidity that you created by buying at the highs to close their positions against you. The no landing nightmare. The mechanics here are ironclad. Strong US economy plus hawkish Fed, high demand for the dollar. Silver is denominated in dollars. When the denominator, the dollar gets more expensive, the numerator, silver, must get cheaper for the price to remain in equilibrium for buyers in other currencies, euro, yen, yuan. For a buyer in India or China, a stronger dollar makes silver even more expensive, which hits physical demand in the moment. The market received the perfect storm: a geopolitical pullback, hawkish labor statistics, rising bond yields, and a strengthening dollar. But if you think 198,000 jobless claims is everything, you aren't looking deep enough. The Federal Reserve Bank of Atlanta has updated its GDP Now model. Do you know what GDP growth they are forecasting for Q4 2025? 5.4%. Think about that. The US economy, burdened with debt and high rates, is growing at 5.4% year. This isn't a soft landing. This is a quark, no landing krog scenario. The plane isn't just not landing. It is climbing with engines on fire. With GDP growth at 5.4%, the Fed has zero reasons to fire up the printing press right now. Liquidity is being squeezed, and in the short term, this creates a toxic environment for precious metals. The market expected a life preserver from Powell, but got a concrete block of statistics. We are seeing a classic death loop. Strong data, fear of the Fed, metals sell off, dollar rise, even more selling. Silver has fallen 4 to 5% from its peak in 48 hours. Technically, we see a bearish engulfing on the daily chart. RSI signals divergence. Short term, this is a slaughter. The iceberg ahead. However, there is one but. Huge. Like the iceberg, this Titanic of a strong economy will soon crash into. While algorithms sell paper silver reacting to unemployment numbers, something is happening in the physical world that doesn't make it into CNBC reports. Look at Asia. Look at the premiums for physical metal in Shanghai. While New York sells paper, the East is sweeping up the metal. The strong economy is killing your silver today to make it priceless tomorrow. Why does this paradox exist? And exactly how will 5.4% GDP growth become the fuel for $100 silver? We will cover that in part 2. We will go down to the engine room and look at the mechanics that will snap this strong dollar in half. If you are looking only at the spot price on your monitor, you are looking at a mirage. The map is not the territory. While algorithms in New York and London were selling paper silver, reacting to strong labor market data, in the physical world, what we call the Great Disconnect was taking place. Fundamental analysis, which day traders ignore, shows a picture exactly opposite to the price chart. Over the last 48 hours, while the price was falling, the structural deficit of silver only deepened. We have been in a state of chronic supply shortage for the 4th year in a row. This is not a temporary supply glitch. This is the new normal that the market refuses to acknowledge until the very last moment. The signal they fear most. The scariest signal for the banking system right now is not the price drop, but the state of the futures curve. We are seeing signs of backwardation. For those unfamiliar with commodities trading terminology, this is an anomalous market state where the price for metal delivery today is higher than the price for delivery in the future. In a normal world, it should be the reverse. Futures should cost more than spot because they include storage and insurance costs, contango. But when backwardation occurs, it is a cry for help from the industry. It means consumers, factories, plants, tech giants are so desperately in need of physical metal right now that they are ready to overpay for immediate delivery, ignoring any costs. This is the most reliable indicator of a real physical deficit that cannot be faked on paper. The irony of the strong economy. Why is this happening exactly now when US GDP is growing at 5.4%? Here lies the main irony of the strong economy. The very same 5.4% growth that scared markets with the possibility of harsh Fed policy means that the industrial machine is running at full capacity, and modern industry cannot exist without silver. Demand from the industrial sector is absolutely price inelastic. A manufacturer of Tomahawk missiles or the newest AI chips won't stop the assembly line if silver rises from $30 to $90. They need the metal at any price. Data from January 21st, 2022 confirms the emergence of new, insatiable demand drivers. Artificial intelligence, data centers require more and more silver due to its unique electrical conductivity. Defense. Amid global instability, the defense industry is ramping up consumption for the production of precision weapons and aerospace technology. Green energy. Solar panels are already devouring over 15% of global supply, and this figure is growing exponentially. Here we see that same death loop in action, but from the other side. A strong economy provokes a rise in bond yields, which crushes the paper price of silver. But that same strong economy physically destroys metal stockpiles, consuming it in record volumes. Exchange warehouses at COMEX and the London Bullion Market Association, LBMA, continue to record outflows of physical bars. Flight to reality investors and industrial consumers are taking delivery of real metal because they are losing faith in paper contracts. They see the widening spread between the spot price on the screen and the real price of physical delivery. They fear an exchange default when it reveals that for every 1 real ounce, 100 paper claims have been sold. This is a flight to quality in its most primitive form. If I can't touch it, I don't own it. At the same time, a tectonic shift in the geography of metal ownership is occurring. While the West plays casino with derivatives, the East is building a fortress. Asian markets remain the center of gravity for physical demand. We are receiving reports of sustained high premiums for silver on the Shanghai Gold Exchange, SGE, compared to international prices. This creates ideal conditions for arbitrage. Metal leaks from Western exchanges, where the price is artificially suppressed by paper sales, to the East, where they pay its real value. China isn't just buying, it is tightening export controls on strategic metals, effectively fragmenting the global market. In India, despite high prices, demand is supported by cultural traditions and investment buying, by a population that historically views silver as the poor man's gold. The verdict. Thus, we have two parallel realities. The paper reality. Price falls due to fear of the Fed and a strengthening dollar. The physical reality. Warehouses are emptying, factories demand raw materials, and China is vacuuming up all available supply. The Western banking system tries to maintain control over the price through futures, but it cannot print the physical ounces needed for chips and solar panels. Sooner or later, this abscess will burst. It is impossible to indefinitely suppress the price of an asset that is in deficit and strategically essential for the economy of the future. The current drop is not the end of the bull market. It is a gift. It is an opportunity to exchange overvalued fiat money for an undervalued strategic resource at a price dictated by algorithms that do not understand physical reality. The only question is, who will manage to take advantage of this gift? You, or the industrial giants who are already lined up? While the retail investor stares in panic at the red candles in the terminal, a completely different game is unfolding behind the scenes. This is a game where the rules are written by those with the capital to move markets, not just react to them. If we analyze the money flows over these 48 hours, we see a classic scheme of wealth redistribution from weak hands to smart money. The great redistribution market psychology has performed a somersault. We have shifted from the stage of FOMO, fear of missing out, which drove the price to $95 at the start of the week, to the fear of losing profits. And who pulled the trigger first? Not you. Institutionals did. Fund flow data shows that over $686 million was withdrawn from the largest silver fund, iShares Silver Trust, SLV, during this short period. At first glance, this looks like a flight. But in the world of big finance, nothing is that linear. Smart money used the price spike to historical highs to lock in profits and move to cash. They sold you their contracts at the highs while you were reading news about Greenland and tariffs. And now, when the price has crashed on unemployment news, they are preparing to buy back those same assets, but with a 5-6% discount. This isn't panic, this is cold calculation. The retail versus pro divergence. At the same time, the retail investor is behaving completely differently. Ordinary people continue to storm coin and bullion shops, perceiving any correction as a chance to buy more physical metal. This creates an amazing disconnect. Professionals are dumping paper, while the people are vacuuming up physical. History shows that in the long run, the one who holds the real asset is right, not the one holding a bank's IOU. The hypocrisy of the giants. The most hypocritical part of this situation is the position of the largest banks. Publicly, they may speak of caution, but look at the forecast they send to their VIP clients. Goldman Sachs has just raised its gold forecast to $5,400 per ounce by the end of 2026. Given the historical correlation of the two metals, this automatically implies that silver must trade above 100-110. Citigroup goes even further. They expect silver at $100 by this March, placing a direct bet on the physical deficit. Ask yourself a question. If banks expect silver at $100 in 2 months, why is the price falling today? The answer is simple. They need to shake out the extra passengers. High volatility and margin calls are the best tools to take an asset away from those using too much leverage. Bob Habercorn of RJO Futures calls this the perfect storm. Geopolitical swings create a smokescreen behind which position accumulation takes place. The geopolitical aftertaste. We cannot ignore the geopolitical context we touched on at the beginning. The Greenland crisis ended as quickly as it began, but it exposed the vulnerability of the entire Western model. The threat of 10 to 25% tariffs instantly reminded the market how fragile global supply chains are. Silver is not just money. It is a strategic raw material for electronics and green energy. Any hint of a trade war turns it from an investment tool into a resource of national security. Even after the de-escalation in Davos and Trump's speech, the aftertaste remains. The market realized global trade rules can be rewritten overnight by a single tweet or ultimatum. In such conditions, holding assets dependent on counterparties and logistics, paper contracts, becomes an unjustified risk. That is precisely why, despite silver's correction, gold held up much more confidently, trading near its all-time highs around $4,800. Gold is the money of kings. It senses systemic risk better than any analyst. And the fact that gold didn't collapse alongside silver suggests that big players are still hedging against something bigger than just an unemployment report. The hidden war right now, we are observing a hidden war between two asset classes. On one side, the dollar and treasuries, which receive doping in the form of strong statistics and yield growth to 4.26%. On the other side, real assets, gold and silver, supported by physical deficits and distrust in the system. The strong U.S. economy, trumpeted by the GDP now model with a growth forecast of 5.4%, actually works against the dollar in the long term. Such explosive growth at full employment will inevitably lead to a new spiral of inflation. The Fed will find itself in zugzwang. They won't be able to raise rates high enough to kill inflation without collapsing the debt market, which is already bursting at the seams. In this context, the current drop in silver is a temporary anomaly caused by an algorithmic reaction to a single number. Fundamentally, smart money understands inflation will return and it will be brutal. This means the real rate, yield minus inflation, will become negative again, which is rocket fuel for precious metals. Western regulators are trying to bring down the fever by manipulating the paper price, but they cannot cancel the laws of physics. The metal deficit in the warehouses hasn't gone anywhere. What does all this mean personally for you, for your retirement account, and for that stack of coins you might be holding in a safe? We have arrived at the most important part, a survival strategy for when macroeconomics has gone mad. Right now, many of you feel fear. You see the price of silver, which just yesterday was storming $96, fighting today to stay above $91. You are asking yourself, is the rally over? Did I buy the top again? The answer depends on which game you are playing. The casino game played by HFT algorithms, or the wealth preservation game played by central banks. Let's look at the roadmap for the coming weeks. Probability analysis paints three scenarios. The roadmap, the base case, the meat grinder, 60% probability. We face an exhausting consolidation. The market must digest the shock of the unemployment data. We will see sawtooth action in the $90, $94 range. Market makers will intentionally keep the price in this corridor to fray retail investors' nerves and force them to sell. They will wait for new data, the PCE index or the next Fed meeting, to pick a direction. In this scenario, the $90 level will be defended by physical buyers as the last line of defense. The bear case, the gift of the gods, 25% probability. You must be ready for pain. If the dollar continues to strengthen and bond yields go above 4.3%, algorithms could push the price below $90. Technically, this opens the floodgates for a drop to the 84-85 zone. Does that sound scary? For a speculator with leverage, it is death. But for a long-term investor, it is a gift from the gods. The key 20-day and 50-day moving averages sit exactly at 84-85s. This is the zone where the smart money that exited today will re-enter, closing their gaps. If you see 85, don't panic, buy. The bull case, the V-shape, 15% probability, an immediate reversal, and a storming of $100 as early as next week. This is possible if a new geopolitical black swan surfaces, or if inflation data turns out so bad that the market realizes the Fed has lost control. The secret of the fiat system. But let's rise above the charts. Look at the horizon. LBMA, London Bullion Market Association, the heart of global metal trading, conducted a survey of analysts. Their consensus for 2026 suggests a doubling of the average silver price compared to last year. Goldman Sachs sets a gold target of $5,400, which mathematically pushes silver above $110. Citigroup expects $100 per ounce by March. Why are these giants so confident in growth, even when the U.S. economy is showing a powerful 5.4% GDP growth? Because they know the secret of the fiat system. A strong economy combined with massive debt is an inflation bomb. The U.S. cannot afford real positive interest rates for a long time. The debt is too large. To service it, they will have to print money or let inflation eat the debt away. In either of these options, silver wins. The current correction is a classic passenger shakeout before the final dash. The market works on the principle of buy the rumor, sell the fact. Rumors of tariffs drove the price up. Facts about their cancellation and a strong labor market drove it down. Your strategy. Your strategy today should be as boring and ruthless as a bank's. Kill the leverage. High volatility is designed to make margin calls take your money. Watch the $90 level. This is the psychological frontier. If it holds, we go to $100. Ignore the noise. Outflows from the SLV ETF are not a sell signal. They are a signal that institutionals are playing their games. The physical market continues to ignore the paper correction. Focus on physical. In conditions where exchange stocks are melting and spreads are rising, owning a paper contract means taking on counterparty risk that does not exist with a physical bar. History rhymes. Every time the system hits a dead end, it tries to release pressure through volatility. They want to scare you with a strong dollar and a strong economy so that you hand over your real assets in exchange for their paper promises. In the 1970s, good statistics often crashed gold in the moment too, But the decade ended with a historic explosion in metals. 2026 is a mirror of that era. Do not let one unemployment report knock you out of a trend that has been forming for decades. The era of paper manipulation is ending. The era of physical reality is arriving. And in that reality, silver is worth much more than $91. Be on the right side of history. Hold the line.